Worst stuff in trading is part of trading. When you are new to trading and you take a loss, it hurts your confidence level, it hurts all the way. So this is part of learning how to trade.
Right.
But when you have traded for a long time, you've seen a lot of things. The question now takes it to the next level where should you take 5 indicators that basically do the same thing and use them as a confirmation of each other? That makes no sense.
Welcome back to another episode of So Let's Talk. Today, we are going to talk about futures and specifically equity index futures. Now, if you are a long-term investor, most likely you are invested in equities and this kind of assets. But if you're more inclined towards trading, perhaps futures products are something that you may want to consider or you may want to explore further, right? Today's episode is sponsored by Affin Hwang Investment Bank. We are going to talk about our sponsor a little bit later, but today I would like to drill right into the topic for today. So for those who are into long-term investments, most likely you are into the spot market. You buy equities, you buy specific stocks and keep it for long-term for the long-term benefit of it. If you are more inclined towards trading, then perhaps futures product is something that you want to explore and you want to find out further, discover a new realm of investment, right? And today I want to talk specifically about equities index futures. I'm going to talk about it in 4 different segments. First of all, I think we need to understand what is the DNA of the market, what drives the market up and down, and at what quantum. To understand that is very important because it helps you to plan what is the strategy for you to trade in index futures, right? Then next, I'm going to have our special guest, Jose Blasco, today. Welcome back to the show. He's going to share with us what are the ways to trade in index futures. Maybe because of certain DNA, so therefore when we are approaching the index futures, perhaps you may not want to be as aggressive as you trade other assets like gold, for example, right? Section 3, after that, then perhaps Jose can share with us your experience throughout your years of trading and all that. What have you seen? What are your pitfalls and what are the bigger success that you have in your trading journey? Mm-hmm. And last but not least, before we do this shooting, we actually compile some questions from our audience through our IG account, FAQ Show. And we have collected some of the questions. And I think those questions are very interesting. And I would like to pose the question to you and maybe you can help us to answer some of them, right? So without further ado, I think let's go straight into our first topic of today, which is the DNA of the market. Now, why I choose this as the first topic is because, Jose, you have been on the show 2 times prior to this. And I think in every show, we talk about the importance of understanding the market DNA before you even try to do something. So first of all, could you just explain briefly, what is this DNA about? Is this like a medical code or, yeah?
I love it. I love the way you describe the market characteristics, what sometimes I call the nature of the beast, right? So when you're going to be dealing with in this case, I'm using the analogy of the market is like an animal. When you're going to be dealing with it, of course, you need to understand its nature, right? So it's not the same to have a little cat or deal with a very big dog, for example. Well, but the markets are the same. I love your way to represent visually what to expect, what to pay attention when it comes to those various markets when you use the term DNA. It's absolutely critical to understand the DNA of the markets because if not, you would be trading something that you don't understand. And therefore, you're exposed to how lucky you're going to be, right? So, while it's fair that, a new trader may not know everything about the characteristics of a market, when getting serious about it, we got to be very specific at understanding the nature of the market, the DNA, right? So in my mind, there are 2 absolutely very key aspects in that DNA, just like the chromosome X and Y. In this case, we are talking about liquidity and volatility. So if a market is not liquid, meaning that there are very few market participants, may still be an asset where being exposed to it makes sense, but then getting in and getting out may not be possible or may not be easy. For example, real estate in certain parts of the country, you may have an easy time to buy a property, but when it's time to sell, maybe you cannot. That would be an example of lack of liquidity. And then the other chromosome, hopefully biologists are not listening to me. The other chromosome of that DNA would be the volatility, right? Yeah. Certain markets have a nature where they move fast And that, depending on what the trader is trying to do, depending on the account size, depending on the level of experience, that could be too much when a market moves too fast, or maybe a market that moves very slow. You may feel that okay, it's a safer asset, but maybe you lose your patience depending on your trading psychology, and then you make mistakes out of trading something too slow. So understanding the DNA of the market is absolutely key, because it helps you to, even before trading it helps you select what is it that is best for you to trade.
Okay, so I guess volatility and liquidity depends on the players in the market. Now, for the context of equity futures, equity index futures, who are the players in the market?
Everybody is in one way exposed to equity markets. When people work and have a job and they don't trade and they don't invest, but they have an EPF, and money goes into the EPF, and the EPF is made of mutual funds, and mutual funds are made of stocks. Well, indirectly, money is coming into the market, even though the person may think I'm not exposed, right? So it's like the equity index markets, like they are very relevant assets around the world, Could be talk about gold, energy markets like oil, very relevant markets out there. But when it comes to equities, it's kind of something that really everybody is exposed to in one way or another.
Right. But within that context of everybody, I suppose some people, they would put their money with fund managers, and fund managers are directly dealing with these futures markets. And on the other hand, some individuals, they will think that, I don't really trust my fund manager. I want to do it myself. So they are more like the retail kind of traders in the market. So what are the different characteristics between an institutional trader and a mom and pop trader like you and me?
Well, the very big difference is size. That's the very big difference, right? I mean, there are multiple other differences I'll mention in a moment, but size is the big one. And what I mean by size is when a very large fund manager, a very large investment bank, a very large trader, a very large pension fund, insurance company takes a trade in the marketplace, their size is so large that they may even move the market themselves. Whereas for retail traders, even for very wealthy individuals, the reality is that the market absorbs those trades like those individuals never even existed. So that's the very big difference, which, by the way, for the retail traders, in a way, is a great advantage, because you could enter the market and kind of be invisible and benefit from the currents or the trends.
Oh, I see.
Without really suffering that your orders don't get filled because your size is too large.
Right. But I have the impression of the opposite. Because big investors, they have the big funds, they control the market, they can make the market go up or down. Whereas a retail trader, you only have a limited amount of funds. You can't really move the market. You are at the mercy of the big traders.
Well, it is all very relative. Like in life, like in any fields that we could be discussing beyond trading or investing, it's all relative, because when we talk about the large players, let's say, for example, an insurance company that is dealing with very passive, type of funds where they're just putting money for the very long term for people that maybe purchase life insurance policy or something like that. Well, the size is very large, but the reality, and this may or may not be totally politically correct, but the reality is that they may or may not care exactly completely about what the performance is tomorrow or next week. They are really putting the money into the market, so they get their clients invested. They collect fees, which is typically the business model for those firms, and they don't really necessarily care too much about what's going to happen, because it's not the bank money, it's the client money. Some firms are more professional or ethical than others. That's why I mentioned that this may or may not be totally politically correct, but I'm just trying to be pragmatic with, painting a picture here. Whereas when it comes to retail traders or individual investors, the moment you get into a trade, 5 minutes later, you ideally want to be in profit. You don't want to be suffering losses, or anything like that, because it's actually your money. Then, of course, there are many in-betweens. There are indeed very large investment banks, very large companies out there that they trade for a profit in their benefit, or, keeping the interest of their clients as a first priority. And then, therefore, of course, the size may be an advantage, because they have the power to move the market. So at least, they may be able to enter positions, scaling into the positions, generate some effect in the market, then scale out, remove risk, and then stay in the trades to see if the market continues moving in that direction or not.
Right.
So, being large, I guess that in most of the cases, it's an advantage, but it may also be a disadvantage sorry to make this answer a bit long, but there are many angles of observation, which is why I said it's relative. So it may be a disadvantage, because if the only objective of the fund or the large trader is to enter the position, and you have to get filled on a very large amount because it's lots of new client money coming in, and getting filled on all that money means that you move the market, it also means that your average entry price is worsened. Because as you are being filled, the price is moving against you, right? So again, it's all a balancing act. And again, the best thing to do really is to rely on very liquid assets where there are so many market participants that no matter the size of your trades, the market can absorb you.
Right. So I think you rightly pointed out the essence of understanding who are the players in the market, because all these institutional traders, they're trading with a lot of funds, a lot of money, and usually if they want to make all these funds in one move, potentially it's going to disrupt the market movement, right? So they tend to break down their trades into piecemeal and then slowly let the market digest and absorb those extra liquidity coming to the market, right?
Yeah.
So then I guess it's important to understand what is the proportion of a market between the retail investors and the institutional traders. In the case of CME's product, like the Nasdaq Micro, the S&P 500 and all that, do you roughly know what is this composition of players in the market?
Yeah. When it comes to quantity of people trading, of course, the retail is millions of people, where large corporations or large traders are a lesser number. But what matters is not the amount of people trading; is really the volumes they generate.
Correct.
So when it comes to volumes that they generate, is more or less roughly, let's call it 60% in the hands of institutional and 40% in the hands of retail, which is a lot, because a few years ago it would not be 60-40, maybe it would be like 80-20 or something of that sort. But of course, with more and more technology coming in, more and more tools helping people to trade, even when people are not educated at a professional level, and people can still trade from home, with more advanced trading platforms, easier software to use, more financial products like the micro contracts in futures, for example, that facilitate retail traders to come in and trade, where before maybe they were too large as products to trade for individuals. So with all of that, next thing you know, now it's kind of like 60-40, which kind of like it's bringing us very close to a fair game, isn't it?
Right?
Yeah.
Right. Now, you exactly bring out the point that I want to discuss today, right? So in the past, you are saying that it is more dominated by institutional traders, 80-20. Today, that proportion has become 60-40. So in my context, I call it a change of DNA. It is very different in a market where the institutional traders dominate the market, and now it's kind of balanced. Maybe you can share with us what are the differences when you trade in these two kinds of markets?
Well, to be honest, the differences, if I was to use a term, the word that just popped in my mind right now is the word myth. Okay.
Myth. Okay, so it's not true.
Well, actually, it's always been kind of like presented out there when you read the literature out there in the market. I'm talking about, let's say, a few years back or something like that. So it's always been presented like individual traders are going to have a very difficult time. They really need to rely on the professionals because they stand no chance by themselves. And the reality is that it's a bit of a myth, because while institutions may have an advantage because of size, as we said earlier, and also because they may have scientists in-house and they may have access to market data that individuals don't have, and all of those things, of course, they have an advantage. But at the same time, institutions also compete against each other too. Right? And a very large investment bank may be buying where another very large investment bank is shorting, and they may hurt themselves,
Yep.
So it's not like institutions always win and the individual investors always lost. It is not the case at all. Exiting a position and sell doesn't mean you're shorting the markets. It may mean that you are just closing a very large profit you just made. And maybe you are selling because institutions buy from you. It doesn't mean that your exit is wrong. You just close on a very large profit. So congratulations, actually. In other words, it's all very much relative, and it's been a bit, for sure, it's always been and still is that, an institution that may have a team of researchers of 30 very smart guys with PhDs, with 30 developers that code AI. Of course, they have an advantage compared to an individual trader trading from home. But they also have the pain of having to move huge amounts of volumes where they hurt themselves by getting everything filled because they move the market, whereas the individual trader these days have access to technologies that you could use from home and be invisible to the market because of a lesser size, and be in a position that as long as that individual investor is well educated, takes it seriously, manages emotions, manages risk, that person truly has a chance and is competing in a fair game with more or less the same odds that institutions may have. So that's why I was using the term myth, because it's not that imbalanced. Okay, it is not that imbalanced, and through time, it's becoming less and less imbalanced.
Right. Okay. I always have these questions in mind when it comes to futures, especially equities index futures. But very often, when you look at what spot market is trading and what the futures market is trading, the index future is trading, sometimes there's a discrepancy. Sometimes futures trades higher, sometimes it's lower. Why does that happen? Given that everything is the same, everyone's information is the same.
Yeah, well, there are multiple elements that are the reason for this. Okay, first of all, I'll just, if that's okay, I'll share something, let's call it funny.
Sure.
When I started my my trading journey, that was a bunch of years ago, but because futures has the word futures in it, right? So my thinking about futures markets versus indices or stocks, my thinking was that, well, if you look at a futures chart, you know what the future will be. So then you know what the stocks and the index is going to do, right? And that is kind of funny now that obviously I know what futures are because that's absolutely not what futures are. Right. Futures are called futures because, again, if you were to hold a futures contract to expiration, so you will get a future delivery of an asset at a 2 days price into a future date. Again, that's a bit maybe even too technical. It's not even relevant at this stage in the conversation, but that's why it's called futures. So first of all, I wanted to clarify to answer your question that futures is not related to the futures price of whatever we are assessing. So let's say you are comparing the Nasdaq index or the S&P 500 index or 500 stocks from the S&P 500 index. You compare the performance of those 500 stocks and the index versus S&P futures or Nasdaq futures. First thing that we need to understand is that the underlying, meaning the reference point, is the same. But the asset that you trade is a different thing. So first of all, stocks and indices, they don't expire.
Right.
Whereas futures, not only they expire, but they have a delivery. And on top of that, you trade them on leverage. So when you trade on leverage, which is a beautiful thing, to be honest. It basically means that instead of you have to pay for the thing and hold it, so you just need to put some collateral money on the side. So if you get losses, the losses will be paid from the collateral. But you don't need to pay for the whole asset because it's not delivered to you yet until the future date, right? So you just need that collateral money, right? But there is an implication. So while you are not paying for the asset, if you were to hold the contract into the future, then you will have a delivery, which means that somehow you are exposed now to something that is worth much more than what you would get in the future. So I know this is a long explanation, but think about it from the term that it's kind of like you are getting a loan. You are exposed to something that is pricier by putting less money now, so sometime in the future it'll be yours. In other words, you have an interest rate built in the price of the future based on its expiration date. Okay. And just because of that, you have some effects in price. I'm going to use a couple of terms which are technical, just so people can Google them and read about a little bit about them. The terms are contango and backwardation, okay, or forwardation and backwardation. Very ugly words. But basically what that means is that, there is a built-in effect in the price because you have that future delivery and you trade on leverage. So there is like a loan effect. So therefore, the futures prices and the index price or the stock price will never be the same. You always have a differential. And it actually depends on which expiration that you're using, because you could be using, like today actually is rollover day on the S&P futures, right? So today when the future session starts, lots of trading will stop going from the March contract into the June contract. Is what we call rollover day. This happens every 3 months. Easy. So in other words, a lot of money is moving from the March contract into the June contract. So that will have an impact on the June contract. Is the law of supply and demand. So when money is rolling, is floating, is flowing from the March contract that will expire next week into the June contract that will expire in June. That will create an effect where the June contract will raise in value in a way that is not directly linked, is not a linear relationship with the price of the index. So again, there are many phenomena behind the scenes that that impact and generates those effects.
Right. So can I say that whenever you read the news, and the news always like to say that, yesterday's futures price dropped, so we expect that today's spot market, when it opens, is also going to drop as well. That has no direct relationship because you're talking about a different underlying assets?
Yes. Yes, indeed. There is a relationship because in the end, while the prices of futures and the prices of indices are going to be different, the way they move, the direction in which they move, and the magnitudes of the moves when they move tend to be similar. And I didn't say exactly the same, but they tend to be very, very close. Why? Because if not, it would be an arbitrage opportunity, right? You will get future delivery on a future date of futures. So let's say futures became so much more expensive in a way that is crazy. What would you do? You would sell those futures contracts. You would buy the stocks or buy the index, and you wait for the future date and lock in the difference, which is what's called arbitrage, which is basically free money. So if futures or indices start to move away from each other, immediately the large funds that do arbitraging arbitraging type of trading, they would immediately start selling one market, buying the other market, and therefore equalize them. Right. So you never have differences that go too far. The largest I saw, to be honest, was in March 2020 during the pandemic, where that was a crazy one. There was a 10% difference between futures and indices, but it was because the futures market that trade 23 hours a day were moving so fast during the Asian and European session that they locked limit. So the futures exchanges were paralyzed, where the ETFs that haven't started trading yet started trading the day 10% lower. So there was a 10% difference, which is something very, very, very rare. I've never seen that in my whole career, not even in 2008. But anyway, so there are differences, but the movements and the magnitudes of movement tend to be the same. So basically the reaction to news and so on is very similar. And because of that, a typical application of futures used as a reference to trade equities is to look at what the Asian session and the European session have done, which is obviously our daytime in Asia plus the daytime in Europe, which is afternoon and evening here. So we are observing all those times, all those trading activities that may bring, let's say, it brought the futures up, 0.5%. And now in the evening hours, which is morning hour in the US, when the equity markets in the US open, they may say, wait a moment, the futures are up by 50%, which means that a lot of large institutions in Asia and Europe are buying. So that creates a bullish sentiment for the opening in the US time zone. And often you may see continuation. Okay, so it does serve as a reference, but not because futures predict the future. It's because really futures is giving you visibility to the fact that banks and large players in Asia and Europe are bullish or bearish. And that's simply the consequence of futures trade 23 hours a day, whereas stocks trade 6.5 hours a day. So futures give you visibility of what you don't see when you look at the stock price.
And I think now is the best time to talk about our sponsor for this episode. So if you're ready to level up your trading game, Affin Hwang Investment Bank has this campaign called Trade, Win and Repeat CME campaign. And they're offering exciting rewards for you guys. So all you need to do is to trade CME Group products via Affin Hwang Investment Bank Berhad and climb the leaderboard for a chance to win up to 5,000 ringgit in Touch and Go e-wallet credits. On top of that, every month, the first 5 clients who trade 5 lots will win 100 ringgit instantly. But that's not all, okay? Enjoy brokerage rebates during this period of time to reduce your trading fees. If you're new to futures, don't worry, you can still sign up for an account because Affin Hwang Investment Bank has an army of experts, futures experts, to help you to understand the product better. They will guide you step by step to make informed trading decisions. So don't be shy. Feel free to ask them away, and Affin Hwang Investment Bank is there for you. So let's come back to our topic. Let's go into the second part of our conversation, which is how to trade all these index futures, right? So just now we talked about looking at news reports saying that, futures is going to influence how the US spot market is going to open and all that. So let's throw a scenario here, right? How do you use that information to deploy a strategy for the day? Let's say you are residing in the US and you just woke up 8 o'clock in the morning, you read this news and you're a futures trader, how are you going to do a trade for that day?
Very good. Yeah, I mean, there are a million ways on how to expose yourself to take advantage of, what you assess as a market opportunity. And but to break it down, it's at least the way I think it's a good thing to think about a step-by-step type of process, right? First of all, because it's simpler to do. Second, because then you don't forget steps, so you don't get in trouble, all that kind of thing, right? So first step for a trader is to have a directional bias, have a clear, assessed, systematic, objective way to decide the market is going up or the market is going down, and I'm going to expose myself to the move, and then I'm going to manage my risk in case I'm wrong. But the first step one, I need to decide, is it time to buy or is it time to sell? There are many ways on how to do that. There are traders around the world that they don't even look at the futures. They may just look at the trend. Maybe they look at a couple of moving averages. Other more sophisticated traders, they may look at more market data. For example, what has the future been doing during the Asian and European session? Right. So now the US markets are about to open and you have your bias. You want to go long, you want to go short, that kind of thing. So that would be step one, deciding what direction you're going to take. From there, second step would be to decide, okay, so where is my entry and where is my exit? Okay, you may decide, I'm going to go long because the futures have been going up, so I'm going to go long. But before you go long, you may decide, look, before I go long, I want more confirmation. I want a little bit of extra evidence. So here is some sort of a resistance. Let's wait for a breakout. And the moment it breaks out, that's my evidence that I thought it was going to go up. It is indeed going up, so let's get in. So that may set your entry. Okay. And this is just an example. There are many other ways to do it. Some other traders, they may rely on Fibonacci's and they do the opposite. They wait for a retracement into a Fib line and that's when they get in. Million ways on how to do it. But step one, what's your direction? Step two, what's your entry? And then your exit, right? Where are you going to take profits? Because if you don't set that from the beginning, maybe you enter and you have to take profits very soon, right, which makes your reward to risk ratio weak. Right. The trade was not worth it. You just made one and you were risking one. What's the point, right? So you may want to risk one to make three, to make five. So that would be better.
All right. So let's try to play the scenario, right? Yesterday, the inflation report just came out. It was better than the market estimates. It was 2.8% compared to market estimate 2.9% in terms of CPI. I think market is doing well now. Partially it's a technical rebound because we have suffered from days of losses in the market, both in futures, spot market and everything. Market is on a bloodshed, right? So given all this backdrop and you have to do a trade today, how are you going to approach it? Maybe you can share with us how are you going to do that trade?
Yeah, very good. Well, so again, there are many different styles on how to trade. But let's say, for example, the trader is a trend trader. Obviously, I'm just looking at this chart. So what we're seeing here is a daily time frame of the micro E-mini Nasdaq 100 index futures. And we can see clearly that we have a leg down where almost every candles on the way down are red color and only a few are green color, a little bit of a pause, and it kept going. So what do we see at the very end of this move? We see exactly that. Every single candle is being red color. There is one tiny green candle at the very bottom. And today, as we speak, as we are having this conversation, a new red candle is forming next to the green candle. So if you are a trend trader and you rely on the direction of the trend, so you would be ready to short, right? But at the same time, coming back to the example I was mentioning a moment ago, you may look for a little bit of extra evidence. So typical techniques could be, for example, look at the prior candle low. Okay, so we have this green candle that has a specific low. Okay, so here's my line. And so this represents more or less, with putting on the side the lack of precision with my finger on a tablet, this represents the low of the prior day. So you may be looking at this particular today's candle, you may be observing this price action, and if it crosses below the prior day low, then that may trigger your entry into a downtrend if you are a trend trader. So you would not fight the direction of the market if that's your philosophy. Now, maybe your philosophy is different. Maybe you are a bit more of an aggressive trader and you are trying to capitalize on very, very, very powerful reward to risk ratios like 10-to-1s and things like that by catching the turning points before the turning point happens and catch potentially a new trend that hasn't started yet, right? So maybe you would do the opposite. Instead of looking at the low of that particular candle, okay, this is good enough. So we have the dotted line pointing at the high of the prior candle. And what you would do is look for this today's candle to go above that line. And this could be interpreted as a reversal, and therefore that would trigger your entry into a potential new uptrend that hasn't happened yet. And of course, in both cases, the trend trader shorting and the aggressive trend reversal trader getting ready to go long, in both cases, those traders would have a stop on the other side. So if you enter where the dotted line is, your stop would be below the cyan line. If you were to short below the cyan line, then your stop would be above where the dotted line is. Therefore, if you're wrong, you know exactly how much you're going to lose, which is the vertical distance, representing the green candle. Okay? That would be a possible approach, even though, of course, many more details could be employed depending on the complexity of a trading methodology.
Right. But I can see how fantastic is it that you didn't even use any indicator. You just use the candle and you have already come up with a strategy to trade on this Nasdaq Micro futures, right? Would you be confident enough to take a position now, just based on whatever that you just shared with us earlier?
Yeah, well, when it comes to confidence, the thing is that as a person who trades the markets and I look at the markets every day, obviously I have done many more observations beyond what I just said, and therefore my level of confidence is definitely in some place, either long or short. Obviously.
Yeah, maybe you can share with us whether you are going to long or short in today's market.
Well, definitely I would be more bullish than bearish at this stage. Okay, and the reason why is because while there is a saying in Wall Street, which is the markets could remain irrational for longer, that you could remain solvent. We've seen that in prior years, okay? And I don't mean to scare anyone, but again, we've seen it before, so it could happen. As a trader, you always need to be ready for whatever happens, long or short, up or down. Just go with the flow, don't fight it, right? So having said that, the thing is that the way this leg down has been happening is basically very continuous with extremely few pauses. And therefore, whoever wanted to sell probably sold. And therefore, a lot of profit taking or a lot of convenience trading, in the sense that people that want to catch low prices and stuff. So that may be happening as we speak. And something that moves fast in one direction often ends up moving just as fast in the opposite direction. So if this move down had happened with more pauses, I would not be bullish at all. I would be very bearish. But because it happens so fast, so my sentiment is more to the bullish side, even though we need to see the evidence. You don't want to guess it, because guess by definition is low probability, right? So that's why I was mentioning to have a little bit of evidence of a breakout or something like that, right? But your comment about not using indicators on how to do this, like everything in life, there are pros and cons. What I just did is very simple, right? Super simple. And it's a good thing that a trading methodology is simple, because then you don't overthink, you don't make mistakes because it's too complicated. So simple is good in most of the things we do in life. Having said that, the problem with what I just did is that it's not it was simple or not. The problem is not like I use indicators or I didn't. The problem of what I have just done is that it's done manually, and therefore is totally depending on my trading psychology. If I just came from 3 losses in a row, probably the locations of my lines were in a different place. If I came from 5 winners in a row, probably the location of my lines were in a different place. I am experienced. I've done this for a long time, so I can be objective with my manual actions. For a new trader, maybe some indicators, not all of them, but some indicators could be helpful or healthy to make sure that you don't improvise. Okay, that's kind of like the danger of doing things manually or too simplistically, even though simple is good.
Right. What are the few indicators that you would advise the new traders to use?
Well, earlier I mentioned 2 steps, right? Which is, identifying your bias, your direction, and identifying entries and exits. So maybe a trader could use 2 indicators. Right? For example, let's say you want to find direction. So maybe you're going to be looking at, for example, MACD. MACD is a very classical moving average convergence divergence, very classical technical indicator. And when you see the 2 lines, which are now below the 0 line, that's a downtrend. When you see the 2 lines are above the 0 line, that's an uptrend. So now you don't think, you just see the 2 lines are below the 0 line, so you are ready to sell.
Right.
Okay, so that's your bias. Your bias, your directional bias is to be a seller if you use MACD. Right? If you use other tools, you may get other readings. Now, what about your entries and your exits? Well, maybe the trader uses another indicator. Maybe we're going to use FIBs. Okay, so you can use auto FIB extensions, for example, and auto FIB retracement. Actually, I'll do extensions only. And in this case, we are a little bit late to the party here, but let's pretend we are dealing with this particular candle at this stage. Okay, I'll use a vertical line so this is understood at this particular stage. You can see on this particular candle where the vertical line is that there is a moment in time it crossed that bottom Fibonacci line. So this could be your indication that, okay, I am in a downtrend. You can see on the bottom part of MACD is showing a downtrend. And then you can see how it's crossing that Fibonacci line. So that could be your indication. Okay, I'm going short now. And now you have an idea or where, what direction to trade in and when to enter. And then same thing for when to exit. So what I like about this indicator, again, there are many more, and this is not a recommendation, but what I like about this indicator is that I didn't do it manually. Even though it's Fibonacci and you could draw fibs manually, I use the auto fibs, which is automated, so no thinking, no human emotions. I'm just making myself very, very, very objective and less subjective.
Which is very interesting because just now, based on your manual interpretation, you say you are more bullish than bearish. Now, when you pull out the indicators, then suddenly the narrative becomes perhaps it is time to short the market even further.
Well, one of the things that happens with indicators, which is good and bad,
right,
is that there is a lagging effect. There is always a lagging effect with the indicators, always, because they use prior data to compute and present a plot. Therefore, there is always a lagging effect because the fact that you use prior data is just going to generate a lagging effect. I guess it's common sense and obvious. So what's the good news about a lagging effect? Well, it's you got more evidence. That's the good news. What is the bad news about a lagging effect? Where when a move has been running for a long time, which is the case, as I said before, many candles going down nonstop. You can see this MACD is the lowest it's been for a long time, right? So if I compress, you will not see MACDs as low as now for a long time. Even the very large prior move on the left of our screen right now didn't get MACD to go as low, right? And we are that low, which means that this move is very significant. And when something is that significant, well, probably it's too late to continue trading in that direction. So in this case, the lagging effect is against you. Having said that, a bit earlier in the context of this move down that has started, the lagging effect would have served as a confirmation or a little bit of an extra evidence that the move is indeed happening. You are not guessing it. You are not visualizing it just because you are creative in your mind. It's real. It's happening. So the lagging effect is a bit more of an evidence. So like everything in life, everything has pros and cons. It's a matter of understanding the DNA of the markets and also the DNA of your indicators. So you understand the pros and the cons of the tools you use.
Wow, interesting. This is the first time I hear directly from a veteran trader of how to interpret the market. Nice. Okay, next we are going into the next section of our conversation. I would like to pick your mind about some of your most memorable trades, be it like successful trades or some worst mistake that you have done throughout your whole career, right? Maybe we start off by sharing the worst stuff first. So I'm trying to dig out all the bad memories and all that.
It's fine. It's fine.
But yeah.
Worst stuff in trading is part of trading. So, it's, when you are new to trading and you take a loss, it hurts you inside. It hurts your confidence level. It hurts all the way. When you are a bit more experienced and you get used to certain losses, you are okay with that. But then there is that one day that a big one hits you and it destroys you. And the confidence level you build during 2 years is like now you don't know if you're confident anymore, right? So this is part of learning how to trade. But when you have traded for a long time, you've seen a lot of things. So it's not like the market doesn't have other lessons to teach you. We're always learning. Okay, let's be humble. But at the same time, one thing that you have to understand is that number one, losses are part of the game, just like winners are part of the game. And some winners will be small, some winners will be large, some losses will be small, some losses will be large. And it's all good. Right?
Can you remember your largest loss? How much was that?
So I'll share a couple of those. I'll share different experiences and a couple of those. So the first one I remember, I was living in California at the time. So the markets open at 6:30 in the morning. And of course, it was going to be an intense, volatile trading day, and I wanted to trade the intraday section, and I was getting ready for it. But then I got greedy out of being, inexperienced. I got greedy, and I'm like, you know what? It's time to go to bed the day before. It's time to go to bed, but, Asia will start trading in a moment at 11 p.m. California time. Why don't I take a couple of trades to get a feel for the market sentiment, and then I go to sleep, and then I'll wake up at 6 and I'll trade. Well, next thing you know, it's 11 p.m. I'm trading the Asian session. Next thing you know, I'm thinking, oh, you know what? In a moment, the Europeans are going to start trading. why don't I do a couple of trades during the European session? So I get a feel for the Asian session and the European session. And then when the US market opens, I'll be a bit tired, fair enough, but I'll get a good feel for what the market is going to do. Next thing you know, it's 1 p.m. California time, which is the closing time of the US markets, which means I stayed awake to trade the Asian session and the European session and the US session. I never went to bed.
Wow.
I did, not that I did crazy amounts. I did 45 trades that day.
Right.
It's not, I could have done more. It's not like it was crazy, but it was intense. And it was intense with a mindset where I was not even focused because I was physically tired. And on top of that, the markets were, volatile, but beyond volatile, they were undecided. Huge moves to the upside. Next thing you know, same move size to the downside. It's like, so what's the trend, right? So good job from my end in the sense that I'm very disciplined with risk management. So I never got hurt. Actually, I ended the day with a little bit of money. But, actually, you asked me for losses. So that maybe that was not a good example. I'll give you another example now.
No, but that was a good example because you were tired and you're not in good shape.
Yes, exactly. Yeah. I mean, it was not even
was a
worth
bad
it.
experience.
So for the effort of staying so
and
many
you
hours
just made
away,
a little money out of it. Yeah.
I could have ended up in a bad place, to be honest.
Okay.
Right? It's just like, okay, it's good that talking about DNA, I guess my DNA makes me disciplined by nature. So I guess that, I ended up okay in the sense that I didn't get hurt. But during the trading session, there were times where I was underwater. Oh. And then there are times where I was back above water. And, what's the point? So let's trade quality instead of quantity. That was kind of like the lesson that was interesting for me. And then the other one, that one was a loss. Actually, there were multiple losses in a row, and all of them exceeded on the same day at the same time. They all exceeded my expected loss per trade. So that was, I was trading currencies. I mean, I always trade multiple assets. Some of my positions were exposed to the Swiss franc, which I was short the Swiss franc. And what happens is that the regulators in Switzerland, they came up with, we're going to peg the Swiss franc to the price of euro. That was years ago. To be honest, I don't fully remember the year. I would say probably 2011, if I'm not mistaken. I had multiple positions exposed to that currency. They all went against me. I got stopped out on all those trades at the same time. I remember I was watching a 1 minute time frame on the charts. The size of the candle on the 1 minute time frame were like that. That currency used to move 100 pips a day, 100 plus pips per day in the world of currencies. We call it pips. In futures, you can trade currencies and we call it ticks. It's the same thing. So normally that currency moves 100 ticks a day, something like that at that time. Now it's less. It moved in a matter of a minute and a half, 2 minutes, 1,000 over pips. 1,000 over pips against me. Luckily, well, not luckily because it's part of the discipline, I had stops, but all my stops triggered with slippage, which means that you get worse price than expected. Okay, you are slipped, and you get a worse price than expected. So I lost like 30% more than expected per trade, multiple trades at the same time in a moment of like a minute and a half or 2 minutes, right? So that was intense, right? And it was painful at the same time. So grateful to take those losses. Imagine I didn't have stops.
Yeah.
It would not have been like 30% extra loss. It would have been like
200%.
Yeah, well, much more. Instead of 100 pip movement in a day, 1,000 pips. That's 1,000% extra, right? So it would be margin calls. It would be full accounts lost in one trade, complete disaster, right? So, yeah. So that's trading. So you gotta be disciplined. You gotta be methodical. Right. And your question about best trades, to be honest, that I don't have any example of that because, one of the things I've done from a very early stage in my trading, this may be a surprise to you, to be honest, Frankie, but something I done from a very early stage in my trading is to work with a psychology coach to develop a mindset where I don't care.
Whether it is loss or gain, I don't care.
Correct. And I don't care. I don't mean I'm reckless. I don't care. I mean I have a carefree state of mind. I know the next trade is going to be a winner or a loss. I know one of those two is going to happen. I don't know which one. And I know I don't make money because of what's going to happen next trade. I make money because it's what's going to happen after a few trades. So then I have a carefree state of mind. I don't really brag about. And also I'm not shooting for like what some investors may do, and it makes sense, where you may be shooting for like 5 trades a year and you just plan to target this amazing profit in one of the trades and then you remember that profit. For me, I trade actively, as many trades every day, and therefore, I don't care.
Right.
It's a normal thing for me to take profits, sometimes bigger than others. It's a normal thing for me to take losses from time to time too, sometimes bigger than others, and it's all part of the game. So I don't have a clear memory of something that really. Yeah.
Right. One thing that keeps popping up is stop loss. You have your stop loss. You have your stop loss, right? But I guess as a beginner trader, the struggle that we all often have is we don't know where to set the stop loss. Sometimes it could be too early to stop, right? So, or sometimes it could be too late to stop, right? It's no point of setting a loss anyway. So how do you determine where is a good level to do that?
So to be honest, there are many ways on how to approach it. It has a lot to do with a trading philosophy. So first of all, I will say that for people that have been trading before that may be listening to this conversation, so I've heard from people that have some trading experience before, I've heard that all the time, that they tell me, I get stopped out all the time. And then it goes my way, right? So for people that say that, to be honest, it's very simple. Change your entries. Make your entries to be your stops. And then you're going to make money all the time because you tell me that you get stopped out all the time. And that basically reveals that you don't get stopped out all the time. Because if you were to stopped out all the time, then you would know that's your entries and that's it. End of the story. You are now, a super trader in no time. So the reality is that, first of all, stops are needed for risk management. And when it comes to risk management, that's where the philosophy kicks in. So you may have a policy or a mindset when it comes to risk management where your approach is very flexible. And instead of using stop losses, maybe you use hedging techniques. For example, at the beginning, you mentioned at the beginning of our conversation today, you mentioned that many people don't trade futures because they are stock traders and they think of futures like something for active traders only. Well, maybe yes, maybe not. Maybe you are a long-term investment guy with stocks, super passive, super cool, super calm. But then you could use micro futures contracts to hedge your stock position. So when the stocks go down, you make some money with just a little bit of a size using micro futures contracts. So maybe you don't use stops, but you have hedging techniques to protect your risk, and that could be okay. Maybe you have another technique that also does not require the use of stops, whereas you may have what we call scaling in techniques, where you predefine before you start trading, okay, this is my entry number 1. If it goes against me, I'm going to purchase more here. Or if you're shorting, I'm going to short more higher at this price level. So you have multiple entries in case it goes against you. And then you still need to set at some point, what do I do if the whole thing just keeps going against me? When do I get out? So to me, typically the way to set, and then you have the traders that keep it very simple. They just focus on reward and risk. And they want to maximize the relationship between the reward and the risk. We call it the reward to risk ratio. And then they use stops all the time. And they are okay with being stopped out. Even though then it goes their way, they are okay because they made sure the loss was small. So when next time, maybe tomorrow, they take a winner, the winner compared to the loss will give a good relationship between the risk and reward. And it may be more painful to trade like that, but it's very healthy. So it's a matter of digesting the fact that this is healthy for you, even though it may not be appealing. It's like, eating sweets is not good for you. You feel it's easier to eat sweets, but not eating sweets is better for you. The day you understand, you don't feel pain, that you don't eat that cake today, right? Maybe not the best analogy, but you get me, right? So finally, to answer your question, where do you set the stop? Well, to me, no matter your methodology, because there are many ways on how to set entries and exits. Earlier, I talked about Fibonacci, for example, or could be support resistance, could be a pierce of a Bollinger Band, you name it. So whatever contradicts the logic for your entry, that should be your stop. For example, if you enter because of a Fibonacci line and price keeps going and may reach the next Fibonacci line, well, that should be your stop, for example. Right? You have other more original techniques as well. Some people use ATR stops and things like that. So look at market volatility and they calculate, look, as an average, the market moves 20 points a day. So my stop is going to be, 15 points away. So if I kind of get the full market move against me, full market move against me, it means I'm quite wrong. Let's get out. So you can have this type of logics, but in the end, make sure that you come up with a systematic rule on where the stop is. So there is no doubt And most importantly, you always have a contingency plan in place. Could be a stop, could be scaling in, could be hedging, but you know what to do when you're wrong, because this is a problem that happens out there, which is people don't have a plan for what happens when I'm wrong. And then it goes against you and you get paralyzed based on trading psychology, and it keeps going against you. And then you may get a margin call in your account, or you get a real problem where you lost too much. And then you even stop trading, right? So it's problematic. So, yeah.
Right. Wow, it's very insightful. So I have the privilege of speaking with you, so I get all this information from you time to time. But a lot of our followers, of our subscribers, they don't have that, right? So therefore, I posted an IG story to ask them, hey, would you like to ask questions about trading? And we have gathered a list of questions, and perhaps you can help them to,
of course,
answer some of the questions.
Yeah.
So the questions are here. So let's go through them one by one. Let's go with the first one first. Right. So how do I make money when the markets are down? Should I just open short positions?
Yeah, very good. I mean, the short answer is yes. Shorting the markets is how you make money on the way down.
Yeah.
Certain markets around the world don't allow shorting. Like, for example, if you wanted to buy stocks in Bursa Malaysia, for example, given the local regulations, shorting is not allowed unless you are a special type of investor that have been given a special type of approval. But with futures, which is what we're discussing today,
trade both positions.
Not a problem. Yeah. Going long and short is just as normal, because you don't need to own anything. You just need to sell a futures contract or buy a futures contract. It's just a contract which has a predefined value, and you have the right to sell it or buy it. You just click on the sell button. Now you're short.
Cool. All right. The second question. What is the average single trade value of one trade to overall portfolio value? I think this is a very good question, because sometimes people may be too aggressive in their one trade, and then they get stop loss, and then and then only they realize, hey, 60% of my fund is gone, right? So how should we tackle this kind of problem?
Well, so this could be approached from two different angles, which are, brother and sister. They come together. You cannot think about it as like one question only. You have to think about it like as two questions. So first of all is how much capital you are willing to allocate per position, per asset. So a trader needs to have a decision about that. So let's say you have an account with 10,000 ringgit, 100,000 ringgit, whatever the amount is, just pick a round number. Okay, so this is your total amount of money. So you need to decide, number one, how many positions you want to run at the same time, knowing that the more trades you run in parallel, it gets complicated. So maybe a trader may say, look, I'm going to run maximum 4 trades at a time. So let's say that's the decision. And then now that you decided that, then the second part is, okay, but do I want to go with those 4 trades, use all my capital, or do I always want to leave unutilized funds just in case I need to hedge, just in case something happened in the market, which is a new opportunity I was not counting on and I want to benefit from that? So typically a safe approach is to always leave some percentage of a capital unutilized. Okay, so let's go with, you have a 10K account. Let's say you decided 50% I'm going to leave it unutilized. So I'm trading with 5K and I'm going to go with 4 positions. So, maximum 25% of my 5K per position. That would be the first answer. But there is a second part of the question, okay? So that's the first thing. I'm going to call that percentage of allocation. Okay, I'm going to use the term allocation. But beyond allocation, you also need to limit yourself based on the risk per position, because a position may use 25% of half of your capital, but it doesn't mean you're risking it all. Like, for example, if you expose yourself to the S&P 500 futures, with whatever amount of your capital, the probability of you losing all that capital, it's near zero. Because the odds that the S&P 500 will go to zero is basically, I don't know what will need to happen in the world for this to happen. It's seen by most professionals as an impossibility, right? So in other words, you have all that money committed. It's allocated. It doesn't mean you're risking it. So the second part of the question, which I want to point out, which is not there, but it's important, is, okay, how much are you risking out the capital that you're using? And this is defined by where is your entry and where is your stop.
Okay.
So before you enter the trade, you have to decide where do you enter, where do you exit if you're wrong. And the vertical distance will tell you how much you lose. So let's say you are risking 10 points on the S&P and you trade micro E-minis. So that's $5 a point. So 10 points is $50 US, okay? So $50 US, how many ringgit is that? How much percentage of your 25% of your 50% allocated is. And the rule that is normally used in the industry is that you never want this to surpass 2% of your account.
2% of the account.
That's a healthy rule in the industry. Some traders are more aggressive. They go for 5, 10. What's being kind of agreed informally by professionals in the industry is that going above 2% may go against you if you take multiple losses in a row. It starts eroding your capital too fast. So 2% of your account, if your account is 10K, 2% of that is 200. So 200 ringgit, $200, whatever that is what you want to risk per trade in that particular case, beyond how much capital is allocated.
Okay, nice. Third question. We have discussed this question already. How do you set your stop losses? If you missed a part, you can rewind back the video and then you will know the answer. Let's go to the fourth one. This is the opposite of this question. So how do you know when you should take profit?
Well, the first thing is that taking profit should be planned ahead of time. Instead of I get into a trade, let's see if it works or it doesn't. And now that it starts working, let's start thinking when to get out. That's a very relaxed mindset that has a big problem, actually multiple big problems. But the first problem is that if, let's say a trader let's say the trader is being hired by a hedge fund, okay? It's not an individual trader. It's a trader hired by a hedge fund. So there is a boss. There is the head of trading boss watching the trader's activities. And you are the trader hired by the hedge fund and you took a trade and it's working in your favor, but you don't know when to exit. You didn't think about it before you enter, and your head of trading approaches you and says, okay, so you're in this trade, how is it going? And you're making money, oh, good job, okay. How much are you risking in this trade? And you say, I'm risking $1 billion. And how much are you gonna make if you're right? And you're like, I'm not sure. What's gonna happen at that moment is that you're fired immediately because you were taking $1 million risk and you don't know in exchange for what reward. You were not able to evaluate if the risk was worth it, the reward. You were just hoping. Right? So the first thing that you need to do is to implement a methodology where you plan on your exits before you enter. So you know if the trade is worth it or not. And now, once you enter the trade, of course, market conditions could change, and that may lead you to a rectification on your profit exit. Because maybe the market is showing so much more strength. So you decide to maybe scale out a little bit now and move your final target further out. So potentially you can catch and ride a larger move and make more money. So yeah, great. Congratulations. Let's be dynamic about it. But you need to think about it ahead of time. That's absolutely critical for risk management purposes.
Right. But sometimes you will fall into this trap where you set your take profit target. Yet it hits and the market continues to go. You think, maybe I should take a second long position. You take it, you still make money. You took profit. Maybe there's still legs there. I should take a third position to go for long. And this time you get caught and one time you go down all the way and you wipe up your entire loss.
Go down all the way would mean no stop. Okay. Correct?
Fair.
So if you took their first profit, it was a good reward to risk ratio on the first profit.
Okay.
You took the second profit, it was an okay reward to risk ratio on the second profit. And the third one is a loss. And it's a good reward to risk ratio, which means that what you lost is like that, whereas what you made on the other trades is like this. So at the end of the day, you are ahead of the game by a lot. And again, if you have a carefree state of mind, you would totally understand this is part of trading. I didn't know for sure it was going to go my way. I didn't know for sure it was going to go against me. I was smart as exposing myself to the marketplace with risk management under control. And that's how it's done.
All right. And the last question, how many indicators do you need to confirm before opening a position? This is something that we didn't talk about.
Yeah. So again, we talked about earlier, if you don't watch it, you can rewind and watch, isn't it? But we talked about indicators briefly in the sense that they could be a good ally because, they make you more systematic, that you don't have to do things that are manual. And in that sense, you don't improvise. You're not subject to human emotions that much and subjectivity. So they have an advantage. We also talk about the fact that they have a lagging effect, which the lagging effect could be good because it brings in a little bit of extra confirmation, but it may make you late to the party. So that's a problem. Now, the question now takes it to the next level where how many should you use, right? Should you take 5 indicators that basically do the same thing and use them as a confirmation of each other? And if you think about it, that makes no sense, okay? While it's probably something that if you're new to trading, it made sense to you if you thought about it at first from a common sense point of view. If you really think about it more in depth, it doesn't make sense. For example, moving averages. They show you the average movement of the price through time. So if a moving average is going up and price is above, it tells you that through time, as an average, prices have been moving higher. So it's an uptrend. Okay, if you look at MACD, MACD is another indicator, which is moving averages of moving averages, where you calculate a histogram, which is the difference between two moving averages. Some people may say MACD will confirm the trend. Wait a moment. MACD, by calculating two averages, where one is an average of an average, and then calculating the difference between averages, sorry to say that so fast, what you're doing is adding more of a lagging effect.
Yeah.
So, okay, how can you confirm something with an extra lagging effect? I mean, you could say yes, but you get the problem of the lagging effect, right? So now let's say you tell me, I'm going to use moving averages and MACD, which confirm the averages with a lagging effect, but then I'm also going to use RSI, where if RSI is in between 40 and 60, is supposed to represent a trending condition. But wait a moment, what RSI does is look at the price action during the last 14 candles. So if price action has been moving in a direction, it's going to show strength, which if that's the case, you're going to see that on the moving averages and on the MACD. So you basically get the same information all the time. So again, I'm not saying it's wrong. You can be sophisticated and end up with like, okay, so, but wait a moment, my moving averages are set to 20, but my MACD is set to 14. And you change settings and you try to adjust it. And you know what? In some cases, it could work okay, but then market conditions will change to more volatile or less volatile. And then what do you need to do? Go and change the settings, which you would only know the right settings after the fact, which is also a lagging effect, right? So again, to me, I think that finding a balance between simplicity and efficiency is the way to go. And therefore, understanding not only the DNA of the market, as you love to say, but also understanding the DNA of your indicators. What are they trying to do? Is it an oscillator that tells you overbought or oversold conditions? Or is it an indicator that tells you more about the trend? So what is it that it's doing? And pick one, okay, that does trend analysis. Pick one that does overbought, oversold. Pick one maybe that calculates, entries and exits such as FIPS and things like that. Pick indicators that do things that are different. Okay, fine. But pick many indicators just because you feel you get confirmation where they do the same thing with an extra lagging effect. You overcomplicate your life and you end up finding excuses. It's like, wait, the averages are not looking okay, but the MACD looks like is going to do this. And now you make up a story, you make yourself subjective. So yeah, I would say simplicity.
Right. Fantastic session with you. It's always great to have you here, Jose. And if you guys are interested to explore futures further, don't forget to subscribe to FAQ Show because we have more content talking about futures in the next couple of months ahead. And if you would like to get your hands on futures yourself, don't forget to open an account with Affin Hwang Investment Bank. So thanks for watching, and thanks, Jose, again. Thanks for coming to the show.
Thanks, Frank. It's always such a pleasure to be here. Thanks to everyone for watching as well.